Okay, so Arnaud, how are you? Happy New Year.
Uh, Good morning to you. Happy New Year to you too.
Yeah, great. It's been a long time, so would like to get to what's top of mind for you, Arnaud,
Well, we
coming
can
into.
discuss three things. Let's start with the S&P 500 and latch on to what the previous speaker just said, in that we are in a bear market. So let's review the bear market.
Do you
And
want to share your screen while we're doing this?
yes, I can, of
Okay,
course. And let's
just
see.
reminding,
Yeah.
picture speaks 1,000 words. Oh,
Yes. And
all
then we
right.
can maybe move on to some cryptocurrencies and maybe gold. I don't know how
Okay.
many minutes we have left, but that's pretty much it. There's so much to cover, and maybe in the end go a little bit over trading as well, because it's very easy to talk about the markets, but how are you going to use that in real life? How are you going to trade? And one of the things I consistently see and people contact me about is stop losses. Most of the time they contact me because they don't use stop losses and are of course heavily underwater and don't know what to do anymore. When you make a recommendation, sell Ethereum at 3,000, well, it's not a recommendation, that's what my analysis shows. You can do whatever you want to do and then decide not to use it, and it's now trading at 1,200 and you bought it at 4,000. That's of course a sad story and it shouldn't happen. So I want to just show simple math on the importance of using a stop loss, which is so important because we can talk about the markets, but if you don't know how to use that, then don't bother about any of this stuff.
Do you, yeah,
It's where
do
the
you
rubber
teach
hits the
them?
road.
Yeah, do you teach them how to use
Yes.
CIC stops?
All that stuff. Yes, absolutely.
CIC
It's,
means cancel if close.
yes. That's
That's what people do. Oh, I'm going to get stopped out, and they cancel the stop.
Yeah.
When it gets close. So, and
Well,
then
it's better to wish you're out than to
yeah, I know.
to wish you're in.
It's
That's
just
the
a
way it is.
contingency order no one should ever use, and there's no such thing
No,
anyway.
no.
All
But
right.
maybe we can start with that actually. Why not? Why not reverse it? So this is the
All right.
importance of a stop loss, right? Let's just start here because it's so we have two traders, A and B, you and your neighbor, right? We both buy an equity, whatever it is, at $100 per unit, per share, per coin, per ounce, whatever it is, for 10,000, right? We each put in $10,000, so we buy 100 of each. So then trader A sells at $90 for 10% loss. So he has, of course, $9,000 left, right? He lost 10% of 10,000. Well, trader B is the I hold no matter what, right? The hodl, the diamond hands, the buy and hold and hope, that type of stuff.
Yeah.
All right. Eventually, the security bottoms at $10, and then it will rally all the way back to 200. Well, then trader A or B, let's start with this one. It's like your neighbor is walking around. Oh, look at me. I made $20,000, but it still hasn't sold. Meanwhile, trader A is a little smarter. So he sold and he was just waiting it out. And eventually he bought it at $50, and he used an analyst, let's say me, and bought it at 50, and then he sold it at 200. How much does he have at the end of the road? 36,000. So meanwhile, your neighbor still has the Honda CR-V on the driveway, and you can start thinking about maybe upgrading your car. And that's the difference. Meanwhile, trader A didn't have to sit through all these losses, didn't have to bite his nails, get all upset and angry and maybe start yelling at his wife, children, and kicking his dog, and all those nasty things that come with sitting through such deep drawdowns. And trader A was just sitting on its hands, knew he had time, money, and an analyst on the side, and we bought at 50. And if I say personally, I won't claim it, say that I will nail it at $1.10. So just let's be realistic. You rebuy it at half of the retrace, right? That's something. Just be realistic. You never buy at the bottom. But this is the difference. This is the importance.
What if he bought at 50 and got stopped out at 11?
Yeah, that's possible too.
Yeah, everything is.
Of course, but if he would get stopped out at 11, then he wouldn't have adhered to his 10% stop loss. He should have been stopped out at 45.
Right.
That's
true.
But we already bottomed at 10, so we were in a rally. But of course, again, appropriate stop losses.
Look, I've done what I've done that before, where you hold on to things and they become worthless. To me, besides the loss on the trade, the biggest loss is opportunity cost, because when you're locked into a loser that you're nursing, you're more risk averse to take on things that could be great, high probability trades, but you don't do it because you're in the swamp. So
Right.
to me, that's another benefit of using a stop is opportunity loss does not, you don't sit there and watch trade after trade go by, which is something else I've done because I've been stuck.
Right.
So, that's something else you could add to this. And
Oh, absolutely. It is
yeah,
loss of
opportunity
opportunity.
loss. And
Um,
you know what? You could replace money, but you can't replace the time
no,
that you've
no.
wasted hoping to get even someday.
Yes, yes, because that's all you're trying to do at first, right? Break even.
Yeah,
And that's what I often tell these people. Well,
yeah,
your rule number one in trading is to minimize your losses. So
yeah.
if you're now down whatever percentage you are, let's see if we can try to bring it back to at least break even or back to a 10% loss. So you cut your losses and then we restart all over again.
And
Even
you'll
if you're
see you're still a young man, but as years go by, you'll see the value of time becoming more precious than even pips.
yeah,
Than even
that's a
pips. Okay, really.
that's a
All
good
right,
point.
all
That's a
right.
good point. All right. Well, so we started off with the end. That's fine too. I like this.
Okay.
This is really fun to do. Don't have to do anything structured. So that brings me to the S&P 500, which I believe is in a grand or large bear market, a super cycle 4 here in red, and that we topped for a super cycle 3. Now, what does that mean? If we would zoom out and we would go all the way back here to here the 1920s, it's a little hard to see here. The data is not on the screen. Unfortunately, somehow it got shaded. We had super cycle 1 in the 1920s, 1929, and the super cycle 2 was, of course, the 1930s low. And ever since we've rallied, and that rally since 1930 has most likely come to an end.
Okay.
That means we'll be in a prolonged bear market. How long it will take is everybody's best guess, but we can look at previous bear markets and how they behaved of a similar type, meaning we are in a super cycle 4. And we've had fourth waves before. As you know, in Elliott wave, things move in fractals. So we have 5 waves up, 3 waves down. And those 5 waves up are also made up of 5 smaller waves, which in turn are made up of 5 smaller waves. So that's the fractal nature, which allows you to really, for example, already give cautious warnings when a 5th wave structure starts to fail. You know that something more bearish is likely going to happen. And that's really the beauty of the Elliott wave. It gives you a foresight. You don't have to wait for a economic report to come out to already know that the most likely move is probably going to be up or down. So that said, we should be in the super cycle 4. And my humble opinion, and this I posted already in June last year, and it's filled in so far quite nicely. That
Where are we now?
We should now be in this pattern here towards ideally around 4,300 plus minus 200. It's always, of course, impossible to know exactly how high things go. And we should still be, we should either be in this black wave C or still trying to fill out this black wave B. And this is the problem with bear markets. Their predictability becomes less. Why? Because of all the ABCs that we're having that can all overlap. In an impulse, we know from the other wave that wave 4 cannot overlap with wave 1. This wave 4 here cannot overlap this wave 1 here. So it's relatively easy. The only problem we have in the impulse is extension. You think a third wave would go to 161.8% of wave 1, but it can be longer, sometimes much, much longer. It's a luxury problem, right?
Do you trust the time underneath as far as guesstimates?
Reasonably, yes. This is my reasonable forecast based on long-term charts, and also based on what previous fourth waves has done. So I've looked at fourth waves at different degrees ever since we started to rally. So we have this large fourth wave that bottomed March 2020, which was in wave terms a irregular expanded flat, lasted 2 years.
Yeah.
So this is a primary degree, which is 2 degrees lower than what we're currently facing. So then the 2 degrees should at least be higher, longer, should also be 2 degrees bigger, so to say. It should be about at least 6 years. Here we have a major fourth wave, which is even a degree lower than the one that ended in March 2020. It lasted 9 months. Then we have to go here to the 2000 to 2009. This is a cycle 4 wave, which lasted 9 to 10 years. And also this one was a irregular expanded flat, meaning we have a correction, we have a rally back to the all-time highs, sometimes a little bit above it, and then a fast and steep decline, an A, a B, and a C. Those are similar type of patterns. You can see it here, an A, a B, and a C. You have here an A, a B, and a C. The fact that the B wave goes above the all-time high is then a irregular flat. And I can go to the 70s as well. The whole 1960s, 1970s path was also an irregular expanded flat. So all the fourth waves of the major primary cycle degree have all been irregular expanded flats. So if we're now in super cycle 4, it is logical to assume, doesn't have to be, but it's logical to assume it will also be a irregular expanded flat, which is what I've painted out on the canvas here. I view the price chart as a canvas. It's pretty much what it fills in nicely. Eventually get a beautiful picture. And we should now just be in the very early stages of this bear market. And this could last for 10 plus years. Some see it even last into the 2040s. I don't know. It could all be done by the late 2020s as well. I think in this case, timing is a little bit less important. We'll know it eventually once we have more price data. But for now, this is, I think, from a larger cycle perspective, a reasonable time frame, about 10 years. So we're really still in the early stages.
Yeah, what a roller coaster the next decade.
This is an amazing roller coaster. Now, why are we then going to new all-time highs? One of the things, we did it here as well, of course, in February 2020, is that I still find the top we struck in January last year odd. I was looking for higher prices earlier last year. I was still kind of missing a rally to the 5,000s. That would have been, from a Fibonacci perspective or the big time frame, the ideal target. And normally the market doesn't miss those type of upside targets. We had the same here in 2019, 2020. I was looking for a third wave top at around, I believe, 35, 3,600. Didn't get there. We stalled at around 3,000, somewhere around there. Then the B wave does the trick. Yeah, the B wave does the trick. Whatever the reason is, in this case, we've got quantitative easing. Yeah. The B wave will do the trick when the third wave doesn't get us there. It happens on many time frames. And that is a nice little note one can have on their computer. If the third wave doesn't get us there, the B wave of the fourth wave will get us there. It's like the market has a destiny with that number, and for whatever reason it didn't get there, then the B wave will do the trick. And again, fourth waves are most of the time flats. We've seen it in history at the 1960s, 70s, the whole 2000, 2009 time frame, the 2008, 2020 time frame, the 2015. It's full of flats. So that's typical for a fourth wave. And right now we're just trying to decide, are we already in this C wave higher, or are we going to see one leg lower before we rally? And let me show you that here on the shorter time frame. So this is really big, right? This is the big picture.
Yeah,
so this is going to be a roller coaster ride.
Lots of almost Nostradamus.
Yeah, yeah,
right.
Yeah. So eventually we'll bottom out, I believe, somewhere. This stage is, of course, a little bit more guessing, but somewhere around 12, 1300, maybe a little bit lower. But the thing is, with a fourth wave, it tends to retrace most of the previous 1 degree lower fourth wave. So if you look here at the March 2020 low, so this was a wave 5, right? Or this was a wave 5. So it retraced quite a lot of this entire rally since February 2016. I believe that was when Trump was elected, all the way into here. Most of it got retraced by the plunge due to COVID.
Yeah.
And the same we can say here, this black wave 4 retraced. This was actually this October 14 low was based on Ebola virus, I believe, also fourth wave due to a contagious disease, and also retraced it completely, etc., etc. So this is typical for a fourth wave to do. So we should see a low somewhere around the 2009 lows, but not all the way. That would be mostly a little bit too much. So we should find support maybe somewhere in the 1500s, whatever it is. But that's fine. I don't want to nail that too much on the wall just yet. It's the general path that we're looking for. And I posted this already in June, and it's been filling in reasonably well with the A, the B, and the C. And I believe we're in this B wave. But now the question is, shorter term, does the market have a few more tricks up its sleeve? And the rally since December 22 has been quite overlapping nasty. We can kind of view it as what we call a expanding leading diagonal, but it almost went a little bit too high for it. So this is now, I was tracking this one, and you can follow me on Twitter where I regularly post how I'm tracking things. And I posted it here on Twitter how I've been tracking this market using added waves. So this was, for example, on January 3rd. So the option here is that we go have bottom for A, we do a B and then a C, and then we rally. So that was the option I showed on January 3rd. Now fast forward, we got the rally, the drop, and the rally. So this worked out really well. Now I must admit, on January 3rd, I also had a bearish option because the market was so messy. I said, well, we have two options. That's the problem with added wave sometimes, that when there's no clear path, you have different options. But the market is all about possibilities and probabilities, and you as an analyst have to figure out what is the highest probability. And sometimes
would it change your count? Could I ask you, Arno? I think there's I saw a count that could take it down to 36 before we get this.
Oh yeah, that's possible.
3.
Yes.
So I think an X wave may have been the look on it.
Yeah, so sure. Let's see here if I can. This one. So far the market has only rallied 3 waves higher. Yesterday's stab higher was a little bit too high, in my humble opinion, to make it fit as this expanding diagonal that was following. I would have liked it to top out at 39.20. Now we can be working on a little bit more extended diagonal. It is still possible, but we need to hold certain key levels. If not, then all we got, which is also on other indexes, is 3 waves higher. So far, the NASDAQ 100 has done 3 waves higher. The semiconductors have done 3 waves higher off their respective late December 2020 lows. So all these indexes have so far, even the Dow Jones, if I would show that one, has only done 3 waves higher, and that needs to be respected. So let's see here. This is the Dow Jones. Also, so far, 3 waves higher, not 5. The bulls are not out of the woods yet. We need to see 5 waves higher, because we know after 5 waves up, we'll get 3 waves decline, and at minimum another 5 waves up. If we only see 3 waves up, we know it's corrective, and we're going to revisit the lows and probably go below it. So that then brings me to the alternative count that yes, we can revisit the 3600s. So then all we got was a 3-wave bounce. That's called the B wave, and then we still need the C wave. And then from there, we can then restart our rally to this 4300 target zone, which I've had on this map for months now. And it's just a matter of time, it's the importance of time, for the market to figure out how it wants to get there. And that's a problem we sometimes have. We don't really know, especially in B waves. And then we're talking about a B wave of a B wave. It's a correction within a correction. Because remember, this is the larger blue B wave that in the bigger picture will be followed by a quite severe plunge back to, I would say, let's say 2,500 plus or minus 500. Let's just average down for now. So
Okay.
we're still trying to figure out how exactly is this blue B wave going to unfold. And in fact, actually this black B wave, that's where we currently are. So we're really in the weeds, and that takes time, and the market is not making it easy. But I think so far it has only done 3 waves up on most indexes, and that needs to be respected. As I keep telling my members, my premium members, this is a green is gone environment. As soon as your position on the long side is green, it's gone, at least in my humble opinion. Make sure of that. This is not a buy and hold type of market, not at all. It's really trying to figure out what it wants to do. I prefer to see tactical. 5 waves up. You know, that's my preference. We've done enough damage to the downside to consider a rally seriously. But based on new price information that becomes available, the market might decide something else. And then, of course, we have the beauty of the other waves, that if we start going below certain key levels, that we say, you know what, that rally is not going to happen. It's going to have to sit and wait there for a while, and we are going to see the C wave.
Okay.
Just as I think in my last interview with you was September, I was still looking for lower prices. I believe I was looking for about 32, 3,300. Well, we got a little bit south of 3,500, so it wasn't too bad in that sense on the on the low. And again, the market doesn't have to follow these picture perfect Fibonacci extensions, right? It can decide to truncate a little bit.
Is the picture clearer in gold for you?
Yes. So I just started a new service on gold, and I think gold is ready to rally. I think we've done enough. We've done here, so this is a yearly chart of gold, and I really like to start off at a waving with yearly candles. So every candle is 1 year, and it starts here in 1970. And the reason I like to start with the yearly candles, if there are enough, of course, available. I can't do much with 2 or 3 yearly candles, but you know, decades of yearly candles, because a wave follows mass sentiment, and nothing is better expressed as mass sentiment than a long period of time, yearly candles. And then a beautiful method which I've learned from Tony Caldero, who unfortunately passed away several years ago. It's the objective at a wave, is to measure or calculate or assess, whatever you want to call it, corrective waves as down years, or down hours, or down days, or down weeks, because most of the time things do tend to be bullish and rally over time, so up years are impulsive. You don't have to worry about anything else, and then you can get a very nice edit wave path. And we have, since the mid-2000 lows, a impulse on the way up so far, 1 to 2. So we have 2 up years, a down year, 2 up years, then 2 down years, and then up. And I think the last 2 years were what I would call also flat wave 4, and we're now in the starting gates of this wave 5. So I think it is prudent to be bullish on gold. Absolutely. And the gold
looks
miners,
like for me, that would be, we're in drive 2, we're correcting, and it's incomplete till we get a 3 up there.
Yes, correct.
And what's that, 2033?
Yeah, somewhere around there, potentially 2,500, something like that.
Does it take that long to get to 2,500? That's hard to.
No, this will go reasonably rapid. So this is just working with the space available on the chart to keep it legible. So I'm not really a market timer. On how long
on
things
the last
take.
chart you said the date, the years meant something. On this it doesn't.
Yes, yeah, here I've done definitely more in-depth study on market cycles, gone, for example, the type of stuff.
What about, would you chase gold up here, Arno, or would you wait for some type of
I would wait for a retrace. I'm going to wait for a dip and buy. I think that's a low risk buying opportunity. And low risk means not no risk. There's always a risk that my work is wrong, right?
Yeah. So,
But that's the thing, right? So say my work is wrong, and then you just say, okay, let's say I buy it here at 1800. We get a nice dip, and
yeah,
then my risk here is at around 1650. Okay.
right.
If it goes below here, my work was wrong. I was wrong. I'm a
Yeah.
great guy, but I'm not right all the time. So then
We
I
don't
just
walk
out.
on water. Yeah.
Yeah, no, we can't be right all the time. And then I have, like we said, a lot of dry powder left and new opportunity. And hopefully I'm going to catch the rally to 2,500 or however high it wants to go, right? Because the wave might extend. We start off, of course, with the usual standard Fibonacci pattern. And then we see if the market will listen to it, yes or no. That depends. It doesn't have to. The market doesn't owe us anything. As long as the third wave is not the shortest, and as long as the fourth wave doesn't overlap with the first wave, except the diagonal, then we're good to go. That's
Best way to get a hold of you, Arnaut, and for people to find out about your new service.
So yeah, like I said, I'm on Twitter. They get a good glimpse of what I do intraday. That's a good way. It's called @Intel Invest. So @Intel_invest.
Yes.
You can find me there. Please follow me. Lots of good stuff. You can DM me there. I have, of course, my own website, intelligentinvesting.market. There you can look through all the education you want on the wave principle. Sign up for my services. Everything has a 1-week free trial. Don't like it, cancel it. Won't cost you anything. And there's many ways for you to make money off of my work. I have trading algorithms as well. Just for example, for crypto trading, if you just don't want to listen to me yap all the time.
Should we own
about
Bitcoin now, Arnaut, or should we wait?
No, not yet. I wouldn't.
Okay.
I'm still, yes.
Don't give it away. If you want to find out where Arnaut is going to be buying Bitcoin, go check out his website.
Yeah, absolutely. Go check it out. See if you like it.
You could DM me on Twitter with the number.
Sure.
Anyway, Arnaut, it was great talking to you and seeing your work.
Thank you.
Nice telescopic views, and everyone, if you buy something at 100, have your stop at 90. Don't put a CIC on it, which means, oh, I'm going to get stopped out. I'm going to pull it quick. Oh God, and then they get mad. They didn't pull it in time, and it saved their butt. So anyway.
Yes.
Arnaut, my trading warrior brother, I hope you have a great, one of your best years ever, and not just in the markets and in all ways, and appreciate you sharing your hard work with us today.
Oh, thank you so much. And likewise, and hope to talk to you soon again.
We will, buddy.
Awesome.
Okay. Arnout Schure, and follow him on Twitter at Intel_invest. So thank you again, Arnaut, and thank you, everyone. You could join the team in 14 minutes on the Morning Edge. And remember, don't just count your pips, count your blessings. See everyone tomorrow.
Awesome. Thank you.
You're very welcome, buddy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.